What have you adapted, adjusted, tweaked as we go into Q4?
Well, we're still dealing with a lot of uncertainty until they clear up the situation in Washington. I mean, we're either going to get a lot of clarity in the next month or we're going to get chaos. We're betting probably on clarity, but it's we'd like to get there. The other thing that's going on is, if you look at the claims data, there is this lagged effect of the Delta variant. The Delta variant was much worse than anybody could have anticipated back in June, and it did have a drag effect on the U.S. economy and on the global economy. So, we get 6.7% GDP for the second quarter. We think we could be down at 2% for the third quarter. So it's going to be a lot weaker. But that, the good news is that is fading. And we've seen, the number of confirmed cases is down 30% from its peak. It should keep dropping. So I think the fourth quarter will bounce back strongly. So there are just a lot of waves going on here. There's an economic wave, there's a Delta wave, and we just sort of have to work our way through this.
Do the waves devolve in 2022 towards a vicinity of Michael Feroli's call on potential GDP? Is the Kelly glide path sub 3% economic growth?
I think it has to be in the long run. We've seen some significant productivity gains from adjustments made during the pandemic, and I think we can bank those. I think we can hold on to those. But it's going to be pretty hard to add to that a lot going forward. And the problem is we just got no growth in the working age population. I mean, we're barreling towards full employment here, notwithstanding what we saw in claims today. But I think by this time next year, we are going to be at pretty much full employment. And from there, we're only going to get maybe 0.5% per year growth in total workers if we're lucky. It's very hard to build more than 2% GDP growth out of that. So, the good news is we've had some productivity gains recently, but it's hard to see stronger long-term growth without more growth in the labor force.
What kind of participation rate do we have when we get to full employment?
Well, I think the problem is that there's been a drag on participation rates all the way through for the last decade or so as the baby boom retires. Because if you think about it, the participation rate measures the percentage of the population age 16 and older that is working or looking for a job, not 16 to 64, it's 16 to 100. And the problem is that so many baby boomers are still retiring that the labor force participation rate is going to look like it's coming down. In reality, I think we'll see some further bounce as people are able to get back to work after COVID, but I think it will be generally lower than we saw in the last decade going forward. And it's, part of it's demographics. Part of it, frankly, is you're just going to need higher wages to lure people back into the workforce after the pandemic.
All right, before we get there, we learned earlier that Christmas comes in September. Thank you very much, Michelle Meyer. And so we really ought to talk about consumer spending at a time when we were looking at some of the ongoing benefits paid out, the claims actually coming off, the idea of enhanced unemployment going away. How big of a drag, how long lasting of a drag on spending do you expect that to be?
I don't expect it to be much of a drag at all. We still have these child tax benefits, which I think are very powerful. But the other thing that's happened is two things. One, we've had a massive increase in wealth. We've seen about $32 trillion added to wealth since the end of 2019, which is just colossal. But also, a lot of people used their stimulus checks and other benefits during the pandemic to pay down credit cards. And so credit card balances fell very sharply. And now we're seeing them being ramped up again. And I think for lower middle income households, that's what they're going to do. So I think I think even though the growth in income may slow, the growth in spending will not slow as much. And I think we should have a pretty good holiday season if people can find the stuff to buy. Because there's also actually a supply constraint to consumer spending, which I think will stretch out consumer demand into 2022.
Given the price dynamics right now, Dr. Kelly, what do revenues do of corporations? Everything's focused on earnings and up the income statement, but what does actual revenues do given a bit of inflation?
Well, yeah, it is positive for revenues right now, but of course you have to look at inflation and real growth. And what I think is going to happen is, 2022, we're going to come in like a lion and go out like a lamb. We're going to have about 6% real GDP growth, I think, in the fourth quarter, maybe a little bit more. By the fourth quarter of next year, down to 2%. So, and I think also some of this year-over-year inflation will fade as some of the supply chain kinks get worked out. So overall, I think revenue growth for global corporations will slow as we go through 2022. It's pretty good right now, and we've got extraordinary earnings. But I think earnings growth over the next year is going to be much slower partly because top-line revenue growth will be slower.
And then also, though, to the idea of some of the input costs, you talk about supply chain disruptions. You also mentioned earlier that you do expect wages to rise more materially. How much will that actually be a hit to the companies, albeit perhaps a benefit to the underlying economy?
Well, it's a big squeeze on corporate profits. I mean, it is the big line item. And I think what we've seen in the past is, when you have a tight labor market, businesses have to pay up new employees. So when they hire somebody, they got to pay up to hire the person. But now the labor shortage is so pervasive that companies are being forced to raise wages for existing employees just to keep them. And I think that's a big difference here. And so I think that could give you more long-lasting wage growth. And yes, it does squeeze the bottom line for corporations. Now, it doesn't show over the last year because they've been able to take advantage of consumers moving online, technology, Zoom technology, less travel expenses and so forth, which all of these things have helped corporate profits. But going forward, yes, I think strong wage growth will be one of the things slowing profit growth going forward.